Good morning. You've tuned into the IFG weekly stock market wrap. The number one item on our radar for this week is the Federal Reserve meeting, which takes place tomorrow. Now, firstly, we do not expect Bernanke to announce any change to his quantitative easing program, whereby he purchases $85 billion in US Treasuries and mortgage-backed securities every month. We believe at this stage Bernanke is going to run down the remainder of his term at the Federal Reserve. He finishes up in January and then he's handing over to Janet Yellen. So we do not expect any change to quantitative easing for the remaining several months. However, it is important to recognize the fact that economic data in the US is starting to deteriorate. So once Janet Yellen takes over, we're not ruling out the probability that she could increase quantitative easing. Earlier in the summer, we put out a very good paper where we gave 8 reasons why unwinding quantitative easing would be highly unlikely. At the time, the market viewed an unwinding of QE as a done deal. They felt that by the middle of 2014 it would be over. We didn't agree with this. We still hold that view, and we side with the fact that if economic data continues to deteriorate, Janet Yellen could increase it. So come this week, we don't believe Bernanke is going to announce any change. Quantitative easing will continue as per normal. The research paper our investment team is working on this week is around the bull market that we've seen in stocks from 2009. In recent weeks, we've put out a number of papers where we've identified a number of warning signs in relation to this rally over the last 5 years. However, it's important to analyze this rally in the context of the long-term secular bear market which started in 2000. Now, the primary difference between a secular bear market and a more cyclical bull market is in the duration. Secular trends can last up to 18 years. If you look back over the US stock market over the last 130 years, you can clearly see long-term secular bull and bear markets over 16 to 18 years. The last secular bull market we had lasted from 1982 until 2000, where we saw US stocks produce very powerful returns as high as 2,000% over the 18-year period. But this was backed by strong economic growth, strong company profits. But more importantly, long-term secular bull markets start when stocks are extremely undervalued and they end when stocks are extremely overvalued. So the bear market we've been in for the last 13 years has been working to bring down those valuation levels on US stocks. So the key question is, are US stocks cheap enough now to justify the start of a new long-term secular bull market? The research we've been doing says no. More work is still required. So the research paper that we're going to put out this week is around the long-term secular bear market that we've been in for the last 13 years. We put forward a powerful argument why we think we have further to go in relation to this long-term secular bear market. So if you want access to that research paper and our other research papers, check us out on LinkedIn and Twitter. Enjoy the rest of your week, and we'll see you next time.